What's up, guys? Dave here again, your favorite mortgage guy. Want to talk to you about one of the biggest mistakes that I see on people's Schedule E's on their tax return. This is where you're claiming your rental income. The biggest thing is, and I'm going to snip this here really quick for you. The biggest thing is that there's literally add backs to income that are in here. Of course, now I don't know if it's because CPAs are out there and they don't really know what an underwriter considers add backs to income, but it's pretty simple. It's actually here on my calculator, my REO calculator. Insurance, mortgage interest, tax, depreciation. Those are your add backs to your line 21 to your total profit and loss. So I'm just going to kind of like highlight those. We talked about insurance, mortgage interest, taxes, and depreciation. And that is, as of this is a 2021 tax return, that's line 9, 12, 16, and 18 of your 2021 tax return. Now, if if you're doing it right, essentially you take that line 20 you take that line 21, 11090 negative. So let's do negative 11090. And then what we're going to do, we're going to actually add back everything. So the insurance, line 9, 1479, 28826, and mortgage interest on this Schedule E. Now, look, you're already positive. This makes you 19,215 positive for the year. This next one divides it by 12. So now you're already 1601 per month. Just with that add back alone, we're going to keep adding here 8647 in taxes. Now you're at 27,862 in income for the year for that particular property. That's literally 2,300 a month. But we're missing an add back. This particular person, of course, there's nothing on line 18. So this is like a missed opportunity here. Literally, the government says, here, we're going to give you something that's called depreciation. And you're just going like, what is depreciation? And basically like, it's a loophole. They're not really telling you that it's a loophole, but it really is. It's just kind of like this subjective, whatever you want to put in there kind of thing. And then really, you get to write it off. So you write off this depreciation in there, and essentially it could really add a bunch back. Now, this particular person, for whatever reason, did 47 in expenses. Now, it can be argued with some lenders if that was a one-time expense, some of that can be added back into income. But really, I don't know that I would put it in there because not all lenders are going to be okay with that. What I would really recommend here is, putting in depreciation because they're not going to always add back those expenses. So you're now at 27,862 for the year. That's about 2321. Like if you would have just added back like, I don't know, 8 grand in depreciation, I mean, now you're at 2988. You're closer to 3 grand a month in total net 100% rental income, and just a better place to be. So just keep that in mind when you're applying for mortgages in the future, that you want to make sure that depreciation is there on your Schedule E's. All those other things too. If you've got a paid off property, I mean, I kind of get that for cash flow reasons. I have run into a lot of seasoned investors that always want to be leveraged on their rental properties just in case they get into a lawsuit or whatever. So that's always why I always see mortgage interest on these rental properties. But yeah, in terms of this little guy right here, just something that's completely subjective. Hey, I had 15 grand in depreciation last year. Now, boom, your income is suddenly 3571 per month. And that helps you qualify for mortgages in the future. Okay, great. That's it for me. I'm getting off my soapbox. Thanks for watching.